We are ABG and Associates, Michael Crocifolia and me, and so we'll introduce ourselves as we go, and then I'd love to hear y'all introduce yourselves if you're so inclined. Also, we've started doing these webinars. This is not the first one of these that we've done, and we realized that there are some people who have interest in this stuff. We do it all day, every day, so it's kind of like it's like walking for us because we do it so often, but we realize that a lot of people don't, and we're happy to share. And so the dialogue always makes this more fun. If you have questions, make sure you ask. Stop us, interrupt us. It doesn't matter. We're not real formal people. So again, my name's Ashley Garner. I know most of you on here, but I don't know all of you. So hello to everyone. I have been in the real estate business for a long time. I'm 54. And really, it started in high school when my dad started buying old houses near the campus of West Virginia University. And we would renovate them and subdivide them internally into student rental apartments. So I started literally hands-on in the mom and pop version of this exact same business that we are in today. It's the very same business. It's just to a different scale right now. And it's pretty rare that I pick up a hammer anymore. Although I could, if I had to, I could still do it. My journey was when I started buying properties on my own account, I started buying them in, the traditional way people enter this business, I feel like, is you buy a single family, then a duplex, then a triplex. And if you're so inclined, then you ramp up from there. So I followed that same path, and it started to click for me, and I could see that it's working. And then I realized that I was already mathematically eliminated from achieving my goal. Well, and so what I mean by mathematically eliminated is that I was going to run out of time, age, the average life expectancy. I wasn't going to live long enough at the pace I was going. So I decided I wanted to scale it up and buy more units. And so when you buy more units, it costs more money. And then you eventually run out of your own available cash to invest. And so you create opportunities for other people to come and join you on the ride. And that's what this syndication model is. That's the way we run the business now. We're buying bigger properties, and it's created opportunities for limited partners to invest. And we'll get into some more of that later. So I'll turn it over to Michael now, and he can tell you a little bit about his journey.
Afternoon, everybody. If Ashley entered in a traditional way to the real estate business, I probably entered in one of the most untraditional ways. And a lot of people call it the accidental landlord. And this happens to a lot of folks. So this is going back, I've been in real estate 6 years. I started my portfolio in 2019. And Michelle, my mom, is on the call actually, and she will hear a lot of what we experienced growing up through this together. So we got into real estate by way of a restaurant. So obviously the best cash flowing asset you can ever get, right? A restaurant. They have no chance of failure. They're always a good investment. Not so much. So we had a great upbringing. I had a great middle income of the road life growing up, and we had plenty of funds. We enjoyed a comfortable life. But it hit us very square in the face when my father lost his job at one point, that the middle class illusion is very real, that you're really only one step away from not having the income necessary to support your family if somebody decides to relocate a job. My dad was of an age where, he was highly paid, he was making good money. It was hard to get a new job, and probably 100 rejections later, we decided we had to go out and take control of our own destiny. And we did that by opening a small business. So we repurposed his 401k into a restaurant. And it was hard work. It was really tough, to make it last and make it work. There's a reason that 90% of restaurants fail in the first couple of years. So we had a very distinct, unique niche with these pierogies, these dumplings, these Polish delicacies in the Northeast that people love. So we found that people love these pierogies, these homemade recipes that we had, and we decided to scale that up. And we bought a second restaurant to turn it into a wholesaling operation. And then COVID hit. COVID hit, shut down the entire restaurant industry. And what we had just spent a lot of money on, at the time we came up with about $35,000 to buy the asset. And now we had no way of making money from it for God knows how long, because COVID just shut the entire world down. The beauty of this, and my long-winded way of getting into real estate, is that the property had a silver lining. So it had a 5,000 square foot warehouse. It had an unfinished apartment on top of the restaurant, and it had three trailers in the back that all paid lot rent. So I got a very quick, painful crash course in what it meant to have real estate on your balance sheet. And we had to learn, it was either pivot into this world and understand what it meant to be a landlord, or ultimately, we weren't going to have that asset very long. Luckily, we pivoted. We learned what it meant to run this type of business on a small scale, and we scaled from there. So within 5 years, we had about 35 units, and then I moved down to North Carolina from Pennsylvania, and Ashley and I decided to take this to the next level with syndication.
Yep, and that brings us kind of to the current. Currently we have about $40 million worth of assets that we manage, and we're hoping to grow that to about 200 million in the next 3 years, and that'll take us probably pretty close to 1,000 units total. Right now, we're right at about 300 units. So let's see if we can shift down here and let Michael go over like a little bit. So I mentioned syndications. That's the model that we use for our business, and it's important to just give you the basics of that before we dive into the comparison with that with other assets. So take it away, Michael.
Yeah, so I think, from a stock market perspective or a crypto perspective, there's interchanges, there's exchanges and marketplaces where these transactions happen every day, and the access to information is probably a little bit easier than it is on a real estate syndication, which is largely private, So just giving you the basics of it here, there's typically a general partner, limited partner structure. So the general partner would be Ashley and myself, for example, on a particular deal where we have a business around this, where we source deals, whether it's from real estate brokers that we've developed relationships with, or direct to seller campaigns, or on market offerings. We source deals and then underwrite them to see what makes sense for our particular business and what can we offer, what types of properties can we offer, great returns on. We then write letters of intent called an LOI, try to get it under contract, and we work out what's called the capital stack. So the capital stack is how are you going to finance and buy the deal? Oftentimes it's equity. You're raising a portion of the money. Some of it comes from Ashley and myself because the general partners always have to have skin in the game. But then a lot of it come from limited partners. And then that combined equity position gets layered on with some leverage, usually from a finance institution, a bank or a private lender or something like that. And you go and you buy the asset. So a lot of people who got into this business probably thought, that's where the job was done. Okay, we got the asset, but in my mind, that's really where it just begins. That's like the tip of the iceberg because operating the deal for anywhere for the hold period of 3 to 7 years is where you really make the money in this business. And so that's the general partner side, and then the where the investors come in is that limited partner side. So Ashley and I do a lot of the heavy lifting in the work so that the limited partners can be truly passive. And if any of you have your own real estate assets that you own personally or in LLCs, you probably know that there's not much that's passive about it. It's still a business that you have to run. But in our syndication model, it's something where you truly get to be passive, much like you do in the stock market or crypto. So we're pooling funds together to go buy larger assets, typically multifamily in our business model. So our last asset was 196 units based in Jacksonville, North Carolina. And then you're executing a business plan. So there's tons of different ways to go about this business. Some typical ways would be a value add proposition where you buy an asset that needs some work. Maybe it's a C class or a B class property that you want to scale it up. You're going to put in new quartz countertops, vinyl plank flooring, etc. That's what we call a value add so that you can then drive the rents higher and get a better appraised value for the property. Or you take more of a stabilized approach where the asset just needs to be, the occupancy needs to be brought up to scratch. It needs a stable operator, which Ashley and I would be considered in this situation to come in and make sure that the property is running well. And you're going to execute that operational plan until you refinance or ultimately sell the property. Throughout that, on a you know oftentimes quarterly, biannually, maybe an annual basis, distributions are issued from the property. So periodic cash flow is going to be generated when the properties run well. And then we issue those cash flow dividends or distributions out to our investors. You're also going to get distributions of your capital back and profit sharing when we refinance the assets or sell them at the end of the day. These activities result in K1s coming through on your tax returns. So these K1s, which oftentimes come with a big, nice, shiny negative number from Ashley and I, offset your passive income. So when we run our tax studies, we do things called cost segregation studies that allow us to offset all of the income that we generate, so that what it actually looks like, and we'll get into this a little bit more, but you actually look like on paper, you're receiving a paper loss, which helps shelter income. Typically, we're holding projects from 3 to 7 years, and then that it should be considered that this is illiquid. You know, it's pretty much the money's tied up until we execute the plan. So if you're looking for high liquidity, might not be the right investment for you, but other people are okay with it not sitting in a bank account, and you know that's all right too. And then the key drivers in this business are going to be what's the rental growth in a particular area, what's it going to be over time, what is the occupancy rate of a property? Can you control the expenses? What are your interest rates on your debt, cap rates that you're buying at, and also what type of leverage you're taking out? Any questions on that at a high level?
So as we get ready to talk about these other things, let's be very clear. We are not in any way saying that real estate is better than stocks or better than crypto. You know, we're not investment managers, we're not CPAs. We just happen to know the real estate business. We'd like to think pretty well, or at least this niche of it. And we think that there are some advantages to real estate that everyone should consider. You know, for most people, it comes in a way of diversifying a portion of their portfolio into real estate. And so that's why we thought it would be beneficial to do this type of webinar. You guys probably all know what stocks are. They're probably the most common of all equity or investments. You know, but the basics are it's ownership in a public company. They trade them on every business day. That's not a holiday on the market. So there's always a market for them. You can sell them. You know, you can pick up the phone or you can pick up your Robinhood app and buy something or sell something at almost at any time. Obviously, the companies that are issuing the stock are doing so to raise money that they can use in course of their business, and it's very heavily regulated by the government. It's also has that that transparency thing that we'll hit on as well, because they just have a lot of reporting requirements. Now, on the crypto side, that's obviously a relatively newer thing. You know, I know there's to someone like me who's old, it still feels like that's a new thing, but it's been around for a while. So, and I personally, I don't have much in the stock market personally, but I do have some crypto investments. And I kind of, for me, you know how like if you were to bet $5 on a football game, right? And you know, you don't really know about it, but maybe I'll just like it helps me pay attention a little bit more. Now, I don't like to gamble, but that was that same idea for crypto when I got into it. Like, I don't really understand this. I can't get my head around it, but I'm going to go ahead and put a small amount of money into the crypto market and just so I'll pay attention. And sure enough, that's what happened. And so I grew my portfolio a little bit. It turned out I grew it at the time that it was the highest it had ever been. And so then it went down and I was kind of running negative for a while, but now it's back up and it's higher than it's ever been even when I bought it, which indicates the volatility of it. It is a market that's very liquid. It's 24/7. I could pick up my phone right now and buy or sell cryptocurrency. If I wanted to turn it into cash, I could do that right this second. There's lots of advantages to it, and we are going to be hearing more and more about it. The blockchain, the decentralization, the security of it all, smart contracts, all of these things are going to come more and more into our world. What's interesting is you see like the mainstream institutions are now into crypto. And usually when that happens, that means it's not going to go anywhere. And it usually increases the values in general. I think that's a lot of what's happening right now. So this is a little comparison, like side by side chart, which I think is neat. And you'll see on the whiteboard behind me, you can see the whiteboard behind me. I have basically the same little matrix that we have on the slide, but real estate. And so let's compare all of these. So real estate, stocks, and crypto. And we'll just go with the first one, volatility. So volatility means, you know, how fast does it change? And real estate is a low to medium volatility. And probably more towards low. So volatility. So real estate's low volatility, meaning it changes slowly. Certainly the slowest of the three that are on the screen. And I put a check mark. I think that's a good. Stocks are kind of that medium to high volatility. Stocks can change a lot. If some news comes out about tariffs or wars or who knows what, then a new product, then stocks go up and down all day long, all 24/7. And crypto is the same way. If you look at a chart of my Bitcoin portfolio in the last 3 years, it changes a lot and it changes quickly. In real estate, in my opinion, that's a steady thing, and that's one reason that you may want to consider diversifying into real estate is because it's something that it doesn't, you wouldn't expect it to just fall right off the cliff in one day's time. It does change, and we are in the midst of a change right now, but it is a much, much slower moving change. Liquidity. Liquidity is how fast you can get your hands on it, basically. So how fast can you turn it into cash? Well, real estate is one of those things that's very low liquidity. It takes a long time to buy real estate. It takes a long time to sell real estate. The contract period when we put something under contract could be anywhere from 30 to 180 days. It might take 6 months to actually own something after we put it under contract. And it may take 3 months to 6 months to sell it and thus turn your equity into cash. You could have a real estate asset with a lot of equity, meaning the value is over and above what you owe on it, but you can't spend that. You can't go to dinner. You can't pay your light bill with equity. You have to liquidate it somehow. Stocks and crypto are the opposite. They're very liquid. You can now, especially nowadays with apps on your phone, you can just buy and sell something, boom, right now, and it shows up in your cash account right away. So that is a definite difference. And you should keep that in mind if you're going to invest in real estate. Michael mentioned earlier that our typical hold periods are 3 to 7 years. So if you were to invest in something like what we do, then you should expect not to have access to your cash, your investment, until the end of that life cycle. The returns. Now, these are obviously very dependent on all kinds of things, right? So, we happen to think the returns in real estate are very good, but there are some real estate investments where the returns are not good. And that's where you, as an investor, you really have to educate yourself on what you're getting into, who you're getting into it with, and where you're getting into it. So what's the asset class? Who are the people that are running it and taking care of your money? And where is the location? Even if you're a passive investor, you should educate yourself enough to know the basics of that. And at minimum, you should know whether you trust the people that you're investing your money with or not. Michael and I have investors that range all the way from very, very thorough research, detail-oriented people who do all of their own research on the market and the asset. And then we also have people that say, hey, Ash, I don't need to know all that. I'm only doing this because of you. So we've got the whole gamut. But for y'all, you should make your own decisions based on that. We target, and these change too based on the market, but right now we're targeting projects that are, providing around 6% cash on cash or better, and around 20% internal rate of return or better. And again, that changes based on what the market is. Stocks, 10 to 13% is probably considered good for an S&P 500 situation. And then cryptos, they can be 100% or they can be 0%. I've got plenty that I'm losing money on, and I've got some that are better than 60%. Control or effort. So this is where like the effort to acquire and operate. Real estate is a heavy lift in comparison to crypto and stocks. But as a limited partner investor in real estate, it's very, very similar to stocks or crypto, because once you were to sign in, create your investor profile in the portal, and then ACH your money into the investment as an LP, your workload is over at that point. You will receive information like K1s and quarterly updates and checks in the mail and things like that, but you don't actually have to do anything. You don't have to operate it. You don't have to file anything about it. None of that. Same with stocks. Obviously you buy a stock and it just sits there. You don't have to do anything to it or with it. And the same thing with crypto, real estate. So the general partner, which in this case, Michael and I, that's the role we play. Our workload is heavy. I mean, we work on this stuff all day, every day. And there's a lot of work that goes into it. Even today, we've had a very busy day dealing with accountants and property managers and lenders. And that's all the stuff that goes on behind the scenes. Our limited partners don't really know much of that detail at all. All right, transparency. When we syndicate something in this model, we're not necessarily regulated by any government agency that says we have to produce this report on this certain date. In practice, we like to communicate a lot. So, at minimum, we're sending out quarterly financial updates and updates on the property and hopefully checks depending on where we are in the life cycle of the asset. But we communicate more than that too. We put out videos, we send out emails, things like that. And of course, we're always available by phone or text. In the stock market, there's as much as you ever want to read about a publicly traded company and their financial performance, et cetera, et cetera. So that's obviously dictated by the government. And then crypto, I mean, I think the government's trying to get its head around that. They know that there's a lot of money to be made. They want to get their hands in it as much as possible, but it's not overly regulated. It is more than it was for sure, but still probably a long way to go to get to where stocks are. And quite frankly, that's what some people like about it, that it's not regulated that much. So the main risks to each of them in real estate, a large part of your risk, you're betting on the jockey. You probably heard that term. And if you know the people that are doing it and you know their track record and you trust them to execute, then that lowers the risk a lot. But in our case, Michael and I are the ones who run these things, and whoever invests with us is banking on us to do what we say we can do. There are definitely our market risks like debt terms and interest rates, cap rate expansion. Cap rate is a mathematical formula that we use to determine value of assets in commercial real estate. And if the cap rate goes up, then the price goes down. And so cap rate expansion means cap rates get bigger. And when cap rates get bigger, values get lower. So that's a risk. And then, of course, we could just, maybe it costs more to run it or it costs more to fix it up than we thought. So that's obviously also a risk. With stocks, the company, it's probably more rare that the company completely folds or does an Enron type deal. But it does happen, and it happened in 2008 and that era. And so it is possible. And cryptos, the risks there, I mean, they could just go away. Bitcoin has emerged, I think, as more of an asset than a lot of the other ones. And so it seems to have a bit of safety about it, although it's still very volatile. And there are plenty of coins out there that weren't here yesterday and won't be here tomorrow. So you have to educate yourself on that too.
Yeah, and Ashley, there is just a couple of points. So I invested in a crypto exchange platform one time, probably 5, 6 years ago. I'm blanking on what the name of the exchange was, but it was second behind Coinbase, so it was a big name, and it was a stock that I purchased that was managing crypto. So it was a cross of the two that you're looking at, and that went bankrupt, Chapter 11. And so not only did all of the cryptocurrencies experience that issue, but the stock itself went to zero, and we got nothing from it. And that's just one example of the volatility that you don't necessarily associate with Chapter 11 bankruptcies. They still do happen, even if it's not on the scale of Enron. But what I do like about the real estate side is you have so much more control over the asset. So if you and I especially, we can drive performance every day. We can drive those cap rates in a direction that we see as profitable to our investors, more so than you can just phone up the CEO of a company and say, hey, do better. I want my stock price to go up. So
Yeah, right.
we have you actually as an LP have a much more direct line of control into an asset just by phoning us up because we are a direct line of communication.
Yeah, well said. There, you definitely are more connected to something like the real estate with us than you would be to you know, a stock portfolio. So as it regards returns and taxes, and again, this is a very high level thing, but on real estate, cash on cash. So the ways that you make money in real estate or the returns that you would get cash on cash, meaning if you invested a dollar, how many dollars do you get back? And that helps you calculate your cash on cash return. And that's from operations. So that's, you know, for us, our criteria has been to date, and it may change. There are different ways to do this, but so far, our criteria has been that we want assets to perform and create the returns that we require based on what they're doing before we buy them. In other words, falling for that trick that the brokers and the sellers like to try to play, saying, hey, this thing is going to be great. It'll make you 20% return, and all you have to do is redo all the roofs, update all the units, increase the rent by $300 a month. And when you do that, you'll have these returns. That's not the way we play it. We play it like, okay, we have certain expectations and criteria, and we want the property to be performing at that level when we purchase it. And so the idea being, if that's our worst case scenario, that it just stays the same as when we bought it, then we're at least not losing our investors' money. We may not be making them a ton, but we're not going to lose it for them. And for a lot of people, when you're coming into an investment like this, that's your main fear is that you're going to lose whatever money you put in is just going to be gone. And you say, well, I don't know, it seems kind of risky putting money into some apartment complex with Ash and Michael when I could just go buy Apple stock, and I'm pretty sure Apple stock's going to be around. And we totally get that. A lot of people see this real estate game as far more risky than some other investments, but on a well run with good people, we think that it's not. Okay, so and then on stocks, you can make money with if the price goes up, and also you can get paid your dividends on a periodic basis. And on crypto, same thing. The price fluctuates, goes up and down. You can make money on staking your coins, and basically you're kind of letting people use you're kind of lending them your coins, so to speak, and you get paid a bit of a fee or return for that. Now the tax effects. So this is where, in my opinion, this is where real estate really shines over the other things. There are certain things you just can't get with stocks and cryptos and other things. And the tax benefits that come with real estate are very unique, and they're very powerful. And the biggest one, and we did a webinar on this last month, and we have the recording if you'd like to see it. But the biggest one is on through depreciation. So we'll go over that. There's a slide on that near the end, but the bottom line is, and Michael mentioned it earlier, the idea to all this is that we pay ourselves and our investors cash money during the period of ownership, but we also send our investors a K1 with a negative number, meaning it shows a loss on paper, and that loss on paper mostly comes from depreciation. So when we get that cost seg study that Michael mentioned, it'll say that we have X amount of dollars that we can take on depreciation and subtract that from the money that we made. That's very, very powerful. And our opinion of why the government allows you to do that, or at least my opinion, is that the government knows that people need housing and that there are not enough places to live. And so they need people like us to provide places for people to live. And the alternative is, well, there are two, I guess. One is people just don't have a place to live, which is not a good alternative. The other one is that the government has to get in the housing business. And then, my sister lives in Berlin, Germany, by the way. And so when you ride your bike from West Berlin to East Berlin, it just hits you right in the face, the difference between private sector housing and when the government provides you housing. Because when you go to East Berlin, it's all housing, these big tall buildings, this stark concrete. It's just kind of an eerie feeling. And so the government is just not, that's not their best role to provide people housing. So they provide tax benefits, AKA incentives to people like us. So it's like, hey, we need you to provide more housing. So I'm going to give you a break on your taxes so you'll have more money in your pocket to go do that with. And we pass that benefit on to our limited partner investors. Stocks and crypto. Well, stocks with their dividends, most of the time that's recorded or taxed as an ordinary income. And then when you sell it, you're either going to have an ordinary income or a capital gain tax. And same thing with crypto. If you sell the crypto, most of the time there's going to be some sort of capital gain or loss, depending on whether you made or lost money. Then you got so sensitivity and practical tips. So another very powerful thing about real estate, and this is definitely not something you can do with stocks or crypto either. I guess you could, but that'd be pretty risky, is leverage. So when we buy, just use round numbers, right? If we're going to buy something that costs $1 million, and then we're going to go borrow maybe 80% of that or 75% of that, which means that we have to have cash, 25% cash, meaning, so say we have $250,000 and we're going to go buy $1 million asset. Well, if you go to the stock market or the cryptos and you want to buy $1 million worth of Apple stock, well, you have to have $1 million in cash to buy it with. Like I said, you could, I guess, take out your home equity loan and go buy a bunch of stock, but that'd probably be a pretty risky thing to do. So that's huge on real estate. And you get to the benefit of the appreciation on the whole $1 million asset and the returns on the whole $1 million asset, even though you've only invested 250,000. That's kind of a big deal. Michael, any thoughts on that before we shift over, or any questions from anyone?
All good from my side.
So let me see here. Let's see if we can skip down. You should see my screen. I've got all kinds of windows up here. This slide is mainly, we wanted this to be a reminder so that we can go through with y'all what you should ask when you're trying to decide if you want to get into real estate or not. Real estate syndication, again, is how we do it. It's kind of, you think of real estate syndication as just a partnership. It may just be me and Mary Catherine and we go buy something. Well, that's like a partnership, and we probably would buy it in an LLC, and she'd own a percentage of it, and I would own a percentage of it. A syndication is the same thing, except Class A shares, and in our case, we call them Class A shares, and that's limited partner shares. And in the deal we showed you, that Bryn Mawr Village, the limited partners own 80% of that deal, and the general partners, which is Class B shares, which is me and Michael and a one or two other people, we own 20% of the deal. The promoter or the general partner, which is us, will take fees on that. So the most common fees are, you get an acquisition fee, and usually that's like 2% of the total acquisition price, and that's paid to the sponsor or the general partner when it closes. You get an asset management fee because there's a tremendous amount of work just in the operations of the apartment complex or the warehouse building or whatever it is. And so you want somebody to be compensated for that so that they're paying attention and doing a good job taking care of your asset. And in most cases, that's like 1.5% of gross monthly rent collected. Sometimes there is a fee when there's a capital event like a refinance or a sale. And then the percentage would be based on whatever the sale price was or whatever the refinance amount was. So those are the fees. Michael, the promote and carried interest, you want to comment on that any?
I think it's more just, understanding the waterfall of who gets paid when. Oftentimes you have a GP LP split, and then the LPs, you guys would be looking for, in some instances, sometimes the returns are great enough that you don't need a preferred return, but oftentimes deals that perform less great on paper will offer preferred returns at a specific hurdle. It might be 4%, 6%, 8%. that is paid out to the limited partner before the general partner gets any portion. So in an instance where there is a preferred return, a limited partner would receive whatever that preferred return is, call it 6%, cash on cash. And then after that hurdle is cleared, you split it pari passu or on a pro rata basis, which is, whatever the agreed split is. In our case, a Bryn Mawr an 80-20 split, then all of the cash flow past the hurdle gets split 80% to the investor and 20% to the general partnership.
Right. Okay, good. So now access, who can participate in these types of things? In a lot of cases with these syndications, they're only for accredited investors. And so the IRS defines what it means to be an accredited investor. And it's based on net worth and income. And the idea there is that's the government trying to take care of you, saying, well, theoretically, then if they make this amount of money, or if they have this net worth or this license or experience in the world, then they either should know enough to take care of themselves, or they have enough net worth cushion that it's not going to put them, out on the street if this thing fails. So keep your eye on that. We've done some videos on what that means too, or how to determine whether or not you're an accredited investor, and we can share those, of course. We are governed by the Securities and Exchange Commission when it's a syndication, because they say that we are selling a security, and the security is your share of the entity that owns the asset. So we've got to do things like private placement memorandums and operating agreements and subscription documents and things like that. So we have a whole separate attorney team that does just the SEC filings for syndications. Those are, we don't print things out much anymore, but if you printed those out, you would measure those in inches probably. Everything is PDF and electronic signatures, so we don't have to kill that many trees anymore. And again, you want to do your due diligence on who the sponsor is. And ultimately, like most everything else in the world, this comes down to relationships and trust and the people that are involved. And so you just have to, everybody's different. You do your own homework. You decide, hey, I trust this person or I don't. And if you don't, stay away. And there are plenty of people that are trustworthy and capable of making you money in the real estate business. And those are the ones you want to find. So this is the example that we mentioned, that I mentioned just previously. This is the one that we purchased most recently in February of 2025. It's 196 units. It's in Jacksonville, North Carolina. It is an existing property. There's pictures here and some pictures down here at the bottom. And so we bought this thing, and like I said, we used our criteria, which was, does this thing perform at the level that we need it to when we buy it? And the answer was yes. And so during our underwriting, we tend to be like, hey, if it meets this criteria, let's go to the next step and let's keep going until it doesn't meet our criteria. This one continued to meet the criteria, so we pulled the trigger and bought it. So far, it's been a wonderful acquisition. It's a great property. Our occupancy is running, what is it right now, Michael? Like 96, 95,
Lease
96?
is 96%. Yep.
Yeah, 96% occupancy right now. Our rents and fees, so our total income, we're able to grow on a unit by unit basis when we turn them over. There's a high velocity of tenants that come through here. We get applications all the time, and we're very excited about this asset. And we just actually, Monday, the brand new washer and dryers were hooked up in our brand new renovated laundry room. So it's exciting to see those types of things, that benefits of the work that we're doing, and we're giving people a better place to live, and we're also adding value to the asset. So our target returns on that one is average annual return, that's AAR, of 22 or more percent. So what that is, if you took all of the money that you made during your ownership of this investment, in this case, our business plan is 5 years, and then you divide, after it was all over and you divided it by 5 years, then that would be your average annual return. So we're projecting that that's going to be 22% or more. Internal rate of return, that's a calculation that's far too complicated for me to explain in words, but it basically, the gist of it is the total return that you get during your time of ownership, and it's adjusted for the time value of money. And so, for those of you who don't have a gauge for that, an 18 or more up into the 20s, that's a high internal rate of return. That's definitely one of the benefits of investing in, this would be called like a C class property. And that's definitely one of the benefits to investing in a property like that, is that those returns are higher. If you, for comparison's sake, if you were to invest in a Class A, brand new Class A project in downtown Charlotte, those returns would not be that high. That IRR may even be closer to 10%, just to give you some comparison. And then cash on cash, like I explained earlier, we're looking at 6% or more on this one. Now, this other column on the right-hand side of your screen, that is a breakdown of this tax benefit, this cost segregation study, and the orange and green little graphic. That's an actual cutout from the proposal that we have from our engineering firm that's going to go in and do our cost segregation study. And so it's too small for you to see, but the gist of it is that, the conservative estimate for, our depreciation is, say it's the $5 million of the depreciation over the whole thing. And I can't see, it's too small for me to see on that graphic, but
Yeah, so the $5 million is on the higher end of what we're anticipating for the year one loss on the depreciation. So once you look down at the bottom, what it overall means to an investor is that you get to benefit from the pro rata share of the depreciation. So say hypothetically you invest $100,000 into a deal like this, that gets you 1.3% ownership in the overall asset. And then you get to benefit from the $3.5 million loss that we take overall on the entire asset. So you take that 3.5 million, times it by your 1.3% share, that gives you a passive loss on your K1 of $45,000. And this is an estimate because we're basing it off of an estimate from our engineering firm, but that does translate into real dollars saved. So it might not look like it, but if you're receiving that much of a passive loss and you have other passive income to shelter, that could be a real tangible benefit of close to $17,000 on your tax bill for next year.
yeah. And so if you own, like he said, if you own other passive income sources, then it could offset that income. Or if this was the only one that you did own, then the idea is that you could be getting your cash distributions from the ownership of this asset, but not pay any taxes on them until it got past that, until you earned more than that passive loss. It's kind of a complicated thing to say out loud, but again, the gist of it is that you get paid cash money in your pocket, but you show the tax IRS a loss, and so you reduce your taxable income, thus saving real money. And that's a big deal. That is definitely not something you get with crypto or stock.
And if you were able to like that's not even factored into the returns on the left. So if you were to factor that number into the returns on the left, it would boost them further.
Yeah,
So really the
for
returns
sure.
we're showing there are that's like worst case scenario, and it's very likely they will be outperformed.
Yeah. Any questions on that? This is our contact info. The website is a good place to go to learn more about us. We've got a white paper on there that, can explain some things to you. You can sign up for a newsletter if you like. And there's Michael's and my phone numbers. And we're always up for a phone call or an email or a text. And then on social media, we've been putting out a lot of videos on YouTube. We record our webinars and we share those also. So there's a lot of good resources. I'm a real estate geek. And, when I'm cutting the grass or driving the car, I've always got a real estate podcast or something on that I'm listening to. And so if you'd like to have some of those resources, I'm happy to share those with you also. That is the end of our prepared presentation, but we're certainly happy to entertain some dialogue or questions if anybody has any.